Before I get started with this presentation, I must warn you. The views in this video are controversial, and some find my financial predictions scary. Believe me, I don't want to frighten you. However, I can't be silent about my latest research. The fallout and trends explained in this video are among the most important and powerful I've uncovered in my career. You see, over the past 18 months, I've made some bold predictions on many of the web's most popular financial sites, on television, at financial conferences, and on my weekly radio show, Capitalist Times Radio. No one believed me over a year ago when I said it was time to take profits in deepwater contract driller Seadrill due to deteriorating demand and excess rig supply in the deepwater drilling market. Some sneered just a few short weeks ago when I warned Seadrill's dividend wasn't sustainable over the long run and the stock could halve in value. But on the day before Thanksgiving, Seadrill discontinued its dividend, losing 23% in a single trading day. The stock has plummeted 70% since I recommended taking profits more than a year ago. And no one believed me in November when I said the popular fracturing sand companies, including High Crush Partners and US Silica, would be the next casualties in the energy markets. But again, the stocks tumbled more than 30% in less than a month after I issued my warning to sell right away. The critics haven't been able to refute my research. However, they've been unwilling to accept the enormity of the changes underway. Many of my peers in the financial newsletter world would rather you not see the content and research in this video. Listen, I understand their reluctance to accept my conclusions. These pundits stand to lose their shirts as my predictions continue to prove correct. Most are advising readers, listeners, and viewers to do the exact opposite of what I'm about to tell you. Their conventional wisdom is already costing investors, just like you, some serious cash. That's not what I desire for you. Before you dismiss me as some sort of crank, I urge you to keep an open mind and review the detailed information and research I'm about to present. Keep watching this video through to the end, and I believe you'll agree the game-changing conclusions I make are inevitable. In fact, I guarantee you the content of this video is absolutely crucial to your financial well-being if you want to avoid the devastating, wealth-destroying maelstrom that's just beginning to be felt across global markets. I'm not fear-mongering. As I'll explain in a moment, we've seen the exact same conditions in the past, and history is just repeating itself. Challenge every single one of my facts, and you'll find that I'm right about each allegation I make. And then you can decide for yourself. It's about time I introduced myself. Hello, my name is Elliot Yu. I'm the co-founder and chief analyst for Energy and Income Advisor, a comprehensive financial research service dedicated to uncovering the best income and growth investment opportunities in the energy industry. Co-founder Roger Conrad and I are not new to the financial advisory and research business. In fact, we have more than 40 years of combined experience as analysts and editors of some of the largest circulation financial publications in the United States. Our financial advisories have consistently been highly rated by the industry's only independent rating service, the Holbert Financial Digest. You may also recognize us from our frequent appearances on CNBC, Bloomberg Television, and Canada's Business News Network. We've been quoted in a number of major publications, including Barron's, Forbes, the New York Times, and the Washington Post. We're sought-after speakers at investment conferences around North America. And we currently serve tens of thousands of investors worldwide through our financial research firm, Capitalist Times. I've dedicated my career to analyzing and identifying profitable investment opportunities in the energy sector. The official program of the 2008 G8 Summit, held in Hokkaido, Japan, even called me the world's leading energy strategist. I'm not looking to boast or brag. I reference our success and experience analyzing the energy markets because we believe there's a powerful change of trend underway. Simply put, the recent 50% collapse in global oil prices is only the beginning. Geopolitics, economic realities, and fateful decisions taken by the world's largest and most powerful energy firms are set to change world markets with devastating consequences in the very near future. And that is why we've spent several months and hundreds of thousands of dollars digging into the numbers and performing the detailed research necessary to profit from emerging trends. You have a very short window to prepare for the next chapter of this crisis. We're looking for a short period of calm. It's not too late to protect yourself. However, you must act now because by early 2015, the trends I'll reveal in this video will already be underway. Yet, there's a silver lining. While some investors will feel some serious pain in this downturn, a few simple techniques can help you lock in some tasty yields and profit from the coming energy price collapse. If you understand how the cycle works, you'll also be able to take advantage of some unprecedented bargains in the energy space when the timing is ripe. This information is so important that in just a moment, I'm going to do something I've never done before. You see, a few days ago, I was invited to give a presentation for a small group of energy insiders and VIPs in Houston, Texas. That's the heart of America's energy industry. My predictions shocked them. When I returned home, a video of my presentation was sitting in my email inbox. Normally, I wouldn't release this video free of charge. It just wouldn't be fair to my paying subscribers. I nearly deleted the video. However, this time, I just couldn't keep this crucial information under wraps. This video could save you some serious cash over the next 12 months. It may be the most important presentation of my career covering energy markets. I've got to warn you, this video is raw and only lightly edited. My talk was unscripted. However, I just couldn't delay giving you this crucial information any longer, not to clean up the audio or make a few charts look prettier. I guarantee I won't waste your time. Listen to this video through to the end. I'll explain exactly why the pundits have been so wrong about oil prices, and you'll see why the advice of some of the most popular energy analysts out there could cost you some serious cash. Pardon my hoarse voice, and you'll see what I'm talking about. Don't delay. There's only a short window of time, a brief calm before the storm. You must act now to protect yourself and your portfolio. Please don't risk losing your shirt. Watch my short video presentation and decide for yourself.
I know I'm in Houston, so whenever I'm in Houston, I probably don't need to tell people here what's been going on with the price of oil over the last few weeks. That's a chart of going back to the beginning of 2010 of Brent, which is in that orange color, and West Texas Intermediate in the blue color. And you can see that yesterday we closed in the mid-60s, really on both Brent and WTI. Obviously there was a pretty big spread between the two not that long ago, and now we've converged to just a $2 to $3 a barrel spread. But of course, anybody who watches the oil markets knows that this sell-off really accelerated the day after Thanksgiving because of what happened with OPEC, where OPEC decided, instead of cutting production to hold up the price of oil, we're going to basically continue pumping at close to the 30 million barrels a day we've been pumping, 30 to 30.5 million barrels a day we've been pumping, and allow the price of oil to fall and find its own level. And so, a lot of people were surprised by that decision. There were a lot of people, especially, some of the pundits on financial television that were looking for OPEC to cut production, keep up the price of oil, and therefore help us out with all those energy stocks that we all, have been owning all these years. But, they did exactly the opposite. I don't think it was as much of a surprise as some people imagine. I think that Saudi Arabia in particular is reacting to things that happened last time around, back in the 70s and early 80s. And if you look at this chart, this is simply OPEC, total production from OPEC countries, divided by total global production of oil. And you can see in the late 1960s through the 1970s, OPEC's share of global production was generally increasing. And in 1973, they had about 54% of all world oil production was coming from OPEC, which of course gave them an awful lot of power, right? So in 1973, when they had an embargo against the US and Western Europe for oil, even though it only lasted a few months, we saw the price of oil in real terms, inflation-adjusted terms, quadruple in just a matter of days. And anybody who remembers the financial markets back in 1973, 1974, knows that we entered the worst recession up to that point since the Great Depression, so in the post-war era. So they started to use oil as more and more of a weapon against that they could restrict production and keep up the prices of oil artificially by restricting production. And of course, the U.S. was in a poor position at that time because again, U.S. production of oil peaked out in the early 1970s and began declining. At the same time, of course, U.S. consumption of oil in the 1970s was still growing at a very rapid pace. So what that meant, of course, is the gap between the amount of oil we produced domestically and the amount of oil we consumed domestically was growing, and that had to be filled with imports from OPEC, who at the same time was flexing their muscles and trying to keep up the price of oil. But of course, there's another effect, which is that when you restrict production like that, it has certain effects on both demand and supply, which I'll talk about in a little more depth in a moment. But basically what happens is you see, as the price is high in real terms, in the 1970s, between 1970 and 1980, excuse me, got to try to keep this voice from totally going on us, between 1970 and 1980, in real terms, that's inflation-adjusted terms, the price of oil went up 15-fold. So that's a pretty major change for the world economy. In not adjusted for inflation, it was up more than 20-fold. So it was a very dramatic increase in the price of oil. A lot of people think that gold was the best source of inflation hedge in the 1970s, right? But actually, gold did not perform as well in real terms as oil. Oil was a much better store of wealth and went up a lot in inflation-adjusted terms. So what happens when the price of a commodity goes up? People try to look for ways to use less of it, right? And that's exactly what began to happen by the late 1970s. It took some time, but we certainly got there. In 1973, on average, the U.S. consumed about 55 million barrels of oil per month in electric power plants to produce electricity. We were burning oil and oil-related products to produce power, which of course is not very common today. Only really Hawaii and a couple of other isolated places still use, in the U.S., still use oil in large quantities to produce power. We only use about 3 or 4 million barrels of oil a month in power plants in the U.S. today. Between 1973 and 1983, it went from 55 million barrels of oil a month down to about 23 million barrels of oil a month. So if you think about that, that's just one example of how when the price of oil went up, companies found ways to generate power in other ways, using coal, which was, if you remember back in the early 1980s, the U.S. government was actually pushing people to use more coal. Now they're trying to get people to switch to other fuels, but back then coal was the big thing. And certainly other ways as well. I mean, everybody remembers how large cars were, how fuel inefficient cars were back in the early 1970s compared to, say, the mid-late 1980s as well. So we saw a demand response, demand destruction from higher prices. We also, of course, as I'll throw up here in a minute, saw a supply response, which was that non-OPEC production started to ramp up by the late 1970s. So I've divided this up by various countries here. I put the US, UK, Mexico, and Norway. Of course, the main sources of new supply, or some of the bigger sources of new supply we saw, in the US, we had the opening up of Alaska, North Slope of Alaska, greater production from there. In the UK and Norway, it was the North Sea, of course. We also saw Mexico, of course, the Cantarell oil field really ramped up starting in the late 1970s and early 1980s. And so what really happened here was that because the price was so high, it incentivized these oil and gas producing companies to go out and spend a ton of money exploring for and producing more oil in non-OPEC countries. So you can see that between, basically from 1971 up until 1977, 1978, non-OPEC oil production was flat. But as that spending started to catch up and actually show up in production figures, non-OPEC production really ramped up from the late 1970s all the way up until about 1986 or 1987. So there's a big growth in non-OPEC production. At the same time, what was happening in the early 80s in OPEC was that we had prices going up a lot in the 1970s. In the early 1980s, we had demand destruction, right? People conserving oil. We also had the beginnings of that non-OPEC supply response that I just showed you here. So what did Saudi Arabia and the rest of OPEC do to try to counteract that? They did exactly what a lot of people expected them to do this time around in the day after Thanksgiving, which is that they cut production rapidly. And I think a lot of people fail to remember how dramatic their production cuts were in the early 1980s. In 1980, OPEC was pumping more than 30 million barrels of oil a day. By 1985, they were down to about 15 million barrels of oil a day. So their actual production of oil halved. And as everybody's probably aware, the only country within OPEC that sort of reliably does something somewhat similar to what they say they're going to do is Saudi Arabia, which went from 10 million barrels of oil a day in 1980 all the way down to 3.1 million barrels of oil a day in 1985. So yes, that did help to keep up the price of oil after 1980. Oil prices in real terms, this is 2013 dollars, went from over $100 a barrel in 1980. That's, again, it's not nominally, it was 30 something, but in real terms, in inflation adjusted terms, it was over 100 in 1980, down to about 60 on average in 1985, and this is based on West Texas Intermediate. So prices came down, but you can imagine if OPEC hadn't restricted supply that much, they probably would have come down even a lot faster. But one of the effects of artificially propping up the price of oil in the early 1980s was to incentivize that, more growth in non-OPEC production. So what happened back in the early 1980s was OPEC pumped less oil, and the world really didn't stop consuming oil. Non-OPEC just pumped more oil. So non-OPEC countries like the US took market share from Saudi Arabia and all the other OPEC members. And you can really see that in this first chart. OPEC went from over 50% of production in the mid to late 1970s to by 1985, they were only about a quarter of world oil production was coming out of OPEC. So from a Saudi Arabia's perspective, this was a major hit to their oil revenue. In 1980, yes, they were able to keep prices up. But when you take your production down by 70% from 10 million to 3 million, your total revenues shrink dramatically. So, Saudi Arabia has, expensive monarchy, etc. And so by 1985, they were getting really tired of this. What they were saying was, we're keeping down production artificially to try to keep the price up. The higher prices are just making it more economical for the non-OPEC members to pump more oil, and we're losing revenue, and they're getting all the revenue and benefiting from the higher prices that we're generating. So what they said in December 1985 is very similar kind of to what they said on Thanksgiving Day this year. You know what? We're going to pump more oil. We're going to increase production. And as you can see from this chart of OPEC production, they went from 15 million barrels a day or so in 1985 all the way up to back over 25 million barrels a day by the early 1990s. So they ramped up production very rapidly. This time around, they're not saying that they're going to ramp up production because, frankly, they cannot ramp up production. They do not have enough spare capacity to really grow production much beyond maybe another couple million barrels a day. But they are saying we're not going to cut production. And the world oil market is oversupplied right now for some of the reasons that I'll talk about in a moment. So the price has started to fall again. So they're really, I think that a lot of people were surprised, certainly on the financial side, about what Saudi Arabia decided to do the day after Thanksgiving. But if you look at it from a historical perspective, they're really just trying to prevent a repeat of what happened back in 1980, 1985, where they pumped less and less oil, and non-OPEC really was able to ramp up production and take market share aggressively from them. And I think that there's a lot of some pretty dramatic changes going on in the oil market that a lot of people aren't aware of, probably more so here in Houston than other places around the country that I speak. But I think this chart's really fascinating. The upper line, the blue line, is Nigerian oil production, which has been really between 2 and 2.5 million barrels a day, 2.7 million barrels a day, between 2001, which is where this chart begins, all the way up to the present time. it's been trending around that level. And just a couple of years ago, in late 2010, early 2011, the U.S. was importing well over 1 million barrels of oil a day from Nigeria. If you think about that, the U.S. was by far Nigeria's largest customer. And if I, in fact, took this chart back as far as we have data, as far back as we have data on U.S. oil imports from Nigeria, every single month, going back almost 30 years, we imported oil from Nigeria until September of 2014. So that's a dramatic, dramatic shift that over a period of less than 5 years, we went from importing well over 1 million barrels of oil a day from Nigeria to zero. So you can kind of see why OPEC was concerned about what's going on in the U.S., a dramatic increase in U.S. oil production from shale fields like the Bakken Shale of North Dakota, and the Eagle Ford Shale here in southern Texas. And the dramatic ramp up in light oil production in the U.S. is displacing oil imports from countries like Nigeria, but also countries like Saudi Arabia, Kuwait, etc. And Saudi Arabia has been sort of artificially holding up their exports to the U.S. to try to retain a foothold here by forcing it through their joint venture refineries with Shell, etc., trying to hold up their market share. But you can imagine that officials in OPEC look at a chart like this and say this is a huge concern. Our largest customer is no longer a customer. So they're looking at that and saying that's very similar to what happened to us, back in 1980, 1981, 1982. In the short term, and this is just a very basic chart, but if you look at the U.S. oil market even before OPEC made its decision, we looked oversupplied for 2015 as it was. And one of the problems is that we have limited outlets, of course, for our crude oil. We're prohibited by law from exporting oil, though we can, of course, export refined products. And there really are limited demand outlets for all the production growth we've been seeing. Even today, the Energy Information Administration is still projecting, and I think this will probably come down now that prices have come down a little bit, but they're still projecting over 1.1 million barrels a day of oil production growth in 2015 alone. 10 years ago, I was in Washington for a conference, and the big conversation was how much natural gas we were going to have to import from all these countries in the forms of liquefied natural gas, and all the oil we were going to have to import because our oil production and our gas production were declining so rapidly. And now, the fact that, if you told somebody back then, 10, 12 years ago, that we were going to be talking about U.S. oil production growing by 1.1 million barrels a day in a single year, they probably would have laughed you out of the room. But that's what's been happening the last few years. We went from less than 5 million barrels a day to 9 million barrels a day. So, 1.1 million barrels a day of production growth was projected for next year. What are we going to do with all that oil? Our refineries are already operating close to full capacity. Most estimates were that we might be able to squeeze another 200,000 barrels a day on average for the year out of the refineries. We can export a little bit more oil to Canada, maybe another 150,000 barrels a day or so. We can export a little bit of condensate. I'm sure many people here know that back in June, Enterprise Products Partners got a private letter ruling from the Commerce Department allowing them to export some condensate, which is only minimally processed. So that's a little bit of an outlet for all this increase in production. But even if you add up all those numbers, and I think those are very conservative numbers on the left-hand side, there's not enough new sources of demand or trade outlets for our oil production to add up to 1.1 million barrels a day. The numbers just don't really add up. Since Saudi Arabia made this decision, we have another problem, which is that we've started to see, again, on the East Coast, significant imports of Brent, because it's cheaper with Brent where it is for refineries there to import Brent rather than shipping domestic crude from places like the Bakken. So we're now seeing, again, imports kind of forcing their way into the U.S. market, which, of course, doesn't help an already glutted supply situation. So, what really has to happen is that, oil prices have to come down to the point that we see that production growth slow. If you can't use up all that oil, and if you build storage, of course, you're going to see prices come down, right? Because it's an excess of supply. If you have all that oil production, you don't have enough outlets for that crude oil. The only way to make the equation balance in a free market is for the price to adjust and prompt a demand and supply reaction. So in the case of oil, that means the price dropping to the point that people start using more oil. And that the supply begins to slow. The supply growth begins to slow. So in the U.S. right now, I mean, it's interesting. Just, I guess, last week, the government released data on car sales in the U.S., which are compiled from all the major auto manufacturers. And one of the more interesting points of that report was that, Americans have already started buying SUVs and trucks again, less than 6 months from when oil prices were over 100. So we are already seeing some demand response. On the supply side, though, listening to a lot of the conference calls and analyst meetings that the big the big shale producers have been putting on, they're still talking, kind of a good game. They're basically saying, we think oil prices are going to go back up, so we're going to keep kind of a pretty ambitious drilling program. And what I think you're going to need to see is that narrative change to we're going to have to cut spending and spend more within our cash flow. Some of the producers out there, some of the shakier ones, probably don't have the ability to borrow enough money to fund their drilling programs in 2015 if oil prices come down, because the banks are starting to say, well, this is all fine and good. You owe us a lot of money. It was all fine and good when oil was at 100. Now at 65, we're not, maybe we'll cut off your credit card there. So you can kind of see from this chart where the low and high cost of production, this is based on data from Bloomberg, from each of these major basins. So the Bakken Shale, the lowest cost player there needs about $53 a barrel to make a reasonable return on their investment. I think this is based on a 10% return on investment, which is way down, by the way, from what they've been getting at over 100. And the highest cost producer in the Bakken, which is a marginal player, in some place like Montana section of it, needs $90 a barrel. But you can imagine that in order for us to see a supply response, in order for us to see supply in the U.S. actually shrink enough, or demand growth slow, or rather supply growth slow enough to balance the equation, we need to see prices get down, sort of at least into the 50s and stick there for a little while to sort of slow this thing down. And it goes back to what Dan was talking about earlier. The price of oil, in the financial markets anyway, you still have a lot of people out there advising people to buy a lot of these energy stocks on the dip, and I've been covering the energy markets now for 14 years, and have been buying a lot of these stocks and recommending to people that they own a lot of these stocks. And for the first time, except for a period in 2008, 2009, I'm now telling people, you need to pull back a little bit on some of that aggressive energy exposure. We've already seen, Dan mentioned how, there are fewer and fewer stocks going up for the market as a whole, and more stocks going down. We're seeing the same thing in the energy market. A year ago, we started to see some of the deep water contract drillers start to come down, names like Seadrill. More recently, we've seen the fracturing sand companies come down. You certainly, if you listen to management teams of the fracturing sand companies last quarter, they were talking about how great things are, but there's clearly already signs that that's probably going to slow, and those stocks are starting to come down, and it's moving on down the line. Now the good news is that even with oil prices falling, that's the bad news, obviously. The good news is that with oil prices lower or falling, there are an awful lot of companies that actually can do better. And that's kind of what I want to talk about here. Before we get to that, this is just sort of a stylized cycle chart. That yellow is kind of hard to see. I should fix that. But it's a very basic chart, and it really goes back to what I've been talking about in real terms all this time, which is that, let's start on the bottom of the chart. When oil prices are low and falling, what's likely happening? Well, probably people are looking to use more oil, or at least they're not really paying much attention to conservation of oil because they don't need to because the price is low. When the price is low and falling, we probably also aren't seeing much supply growth, right? Because who's going to go out and invest in a multi-billion-dollar deep water development when the price of oil is at $50? Based on results from Seadrill and guys like that, not many people are looking to do that. When prices, at some point though, that lower supply, or that slower supply growth and higher demand caused by the low prices results in a change in the supply-demand balance in favor of rising prices. Now, when you get to that blue segment and sort of the early part of the green segment, that's sort of the sweet spot for the energy market.
And what that is that supply is still falling, because even though the exploration production companies may be spending a little bit more on exploration, it still hasn't shown up in terms of actual output growth. Even back in the 70s, I showed you that chart of non-OPEC production. Oil prices quadrupled in 73, 74, but there wasn't a supply response until 77, 78. It takes time. So you're still seeing supply kind of weak or not growing much, and demand picking up. So prices began to rise very, very quickly. But higher prices, of course, cause us to reach the top of the cycle. High prices cause companies to go out and invest more in oil exploration and production, also cause demand destruction, and we begin the cycle again. So we kind of know what the cycle looks like. The business cycle for oil and most commodities looks something like this. So we kind of know where we're going. The only question is, how fast does it take us to move from one section to the other? And, a lot of people are out there saying now, some people are out there saying now, the commodity super cycle is over. Well, I don't think that's true, because we still have an awful lot of demand growth over the next 10 years. You look at a country like China, there's going to be a lot more oil consumed in China 10 years from now than today. Do you know that the average American consumes about 19 million barrels of oil a year? 19 barrels of oil a year. Consume about 19 million, 20 million barrels a day, but each individual person per capita consumes about 19 or 20 barrels of oil a year. In China, it's about 2.7. So on a per capita basis, the Chinese are still not consuming anything close to what we are. If you look at India, they consume less than a barrel of oil per person per year, compared to, again, 19. If you go back to 1945 or 1950 in Japan, it looked very much like China today. They were only consuming 2 or 3 barrels of oil per person per year. Now they consume 12 or 13 now. So if you look at that, that's a major increase in per capita consumption as these economies grow. We're going to see the same thing out of China. At the same time, as everybody I'm sure here knows, it's becoming harder in many parts of the world to produce more oil. In OPEC, the fields are aging. A lot of these fields were discovered 60 years ago plus. So they're aging. It's becoming harder to increase production. There is less spare capacity in OPEC than there was back in '85. So I don't expect this down cycle to last as long as it did back then. And the commodity super cycle to me just means that the left-hand side of this chart is more powerful and longer lasting than the right-hand side of this chart. But that doesn't mean that there's no right-hand side of the chart. It just means that it doesn't take as long to move through. So that's what I think we're in. We're in a 12, maybe 24-month period of being more on the right-hand side of the chart before things adjust and we start to see the same problems we were talking about just a few years ago. Strong demand growth because the Chinese demand's already picking up as a result of lower prices, and need to spend money to go out and find more oil and gas. I always laugh at these big integrated oil companies, the Chevrons and Shells and Totals and Exxons of the world. They talk about how they're going to keep their capital spending flat but somehow increase their production. But it never seems to work out, year after year. Especially now, it's been very hard for them to actually meet their long-term production growth goals. So if they're actually cutting CapEx, which a lot of them are talking about right now, Shell and Total were the first two, but certainly it's spreading. I don't think there's going to be a whole lot of production growth with prices going down. So that's ultimately going to cause the next upcycle.
Look, I know many of my peers are in serious denial about the potential downside in energy prices. They're still advising investors to buy energy producers on the dip and hold on for a rally in oil prices by next summer. They're hoping for a rally back to $100 a barrel by the end of 2015. However, hope is not an investment strategy. Some predict the Saudis will soon slash production in an effort to buoy prices. However, my firm's research confirms the Saudis can't afford to cut output. They can't afford a repeat of the OPEC market share collapse of the early 1980s. Instead, they want oil prices to fall in the short term. And fall they will. Yes, oil prices have fallen pretty far already and could be due for a short-term bounce, an oversold bounce that could take crude higher into early 2015. However, that move is just the calm before the storm. Oil is headed to $40 per barrel, or even lower, by next summer. Do you think I'm exaggerating? Just remember, no one expected shares of Seadrill to fall more than 70% from their highs. or the formerly red-hot fracturing sand producers to give up years of gains in just a few short weeks this fall. But these former high flyers were crushed and Seadrill's dividend eliminated. Let me ask you a question. Will you act now to protect your portfolio? I hope so, and that's why I wrote this letter. So what can you do? Well, I've done a lot of research on this, and I've found that there are a surprising number of simple things you can do to not only protect what you've currently got, but also potentially make quite a bit of money as oil prices fall in 2015. Here are 5 simple steps I'm recommending. Profit step number 1, hedging your bets. What if I told you that one stock we recommend, as a play on falling oil prices, has soared 60% since mid-October alone? Would you be interested in hearing more about that kind of opportunity? Let's be honest. While the sector has performed well in recent years, energy stocks still account for less than 10% of the S&P 500. Many of the remaining 90% of stocks and sectors actually benefit from lower oil prices. However, only a small handful of names are getting a game-changing boost from lower oil prices, the sort of tailwind that's already powered gains of 100% or more from some of our top hedge recommendations. I don't have time to go through all the details of our top plays on lower oil prices in this short video. However, I will explain everything in full detail in my new report called Hedging Your Bets, Stocks That Thrive When Oil Dives. And I'll gladly give you access to a copy absolutely risk-free. And I'll show you how to get this valuable report risk-free in just a second. Profit step number 2. Pull these babies from the bathwater. How about the names of a handful of tax-advantaged, high-yield stocks that have been caught up in the energy price panic? A classic example of Wall Street throwing the babies out with the bathwater. These stocks are down for no good reason, offering investors the opportunity to lock in high, fast-growing yields by purchasing these stocks at discounted prices. I'm talking about yields of 4%, 5%, and even over 7% from rock-solid income gushers with the potential to generate significant income growth over the next 3 years, regardless of where oil is trading. In our hot-off-the-press special report called Game Plan for Lower Oil Prices, Pull These Babies from the Bathwater, we'll unveil all the details of 5 of our top picks to buy right now at fire sale prices. Plus, I'd like to send you information on a secret high-yield asset class few are talking about. An asset offering yields of 13% or higher that can actually benefit when some energy stocks are forced to cut their dividends and distributions. Profit step number 3, profiting from the pain and collect a 13% yield. I've got to warn you, some pundits are actually telling investors to avoid this asset right now. Yet these securities offered huge returns the last time energy prices fell in 2008 and 2009. We expect total returns of 50% or more over the next 12 to 18 months. This opportunity is a little unconventional, but has been a favorite of wealthier investors for decades. I'd like to give you access to this third valuable report, detailing this secret asset class and strategy, also absolutely risk-free, and I'll show you how to get it in just a second. And what about preserving your wealth? You must avoid the energy stocks that are getting crushed in this bear market. I'm talking about companies like Seadrill, Hi-Crush, and US Silica that could decline 80% or more from their recent highs. Let me ask you a simple question. Have you ever stayed awake at night thinking about the security of your portfolio and the safety of your dividends? Profit step number 4, the energy market's ticking time bomb. In our 4th special report, we'll unveil 3 popular stocks that are extremely dangerous investments. 2 of these dangerous stocks are high-yield securities, popular with safety-conscious income investors. You need to sell the 3 wealth-robbing names in this just-released special report right away. And that brings me to our 5th and final special report. Profit step number 5, a certain winner in uncertain times, our favorite new MLP. Master Limited Partnerships, or MLPs, are a group of tax-advantaged, high-yield investments that have blown the S&P 500 out of the water over the past decade. Over the past 10 years, the industry benchmark Alerian MLP Index has soared 300% compared to a gain of less than 118% for the S&P 500. However, we've identified one simple characteristic you can use to identify the top performing MLPs. One MLP with this simple trait soared 1,160% over the past decade. That's enough to turn a $10,000 investment into nearly $120,000. Another MLP we identified with this same golden characteristic has jumped over 150% since going public just over 2 years ago. That's close to 5 times the return for the S&P 500. You'll be shocked at how well this one simple trick for identifying the top performing MLPs works. And we've included all the details of this strategy and one of our top MLPs to buy right now in our special free report available risk-free for a limited time. Please just give the work I've done a look. Read my 5 special reports, and I believe you will have all the information you need at your disposal. The best part is you can take a look at my research and receive everything I've mentioned here at absolutely no risk or obligation. Simply let me know you'd like to take a trial subscription to our service, Energy and Income Advisor, and I will immediately give you access to all 5 of our newly released research reports. Click the green Subscribe Now button below this video and test our service for 30 days. Download all 5 of our special reports. Read 2 detailed monthly issues of Energy and Income Advisor. Gain exclusive access to our model portfolios, offering suggested allocations for growth, income, aggressive, and conservative investors. Read through our extensive archives. Now let me ask you a simple question. Wouldn't it be great to be able to pose any question you like about the stock market, economy, or individual stocks and bonds and have your questions answered? Let me tell you about our monthly web chats, a feature of our service Roger and I pioneered a decade ago. It is still the most popular feature of the Energy and Income Advisor service. These chats are an opportunity for you to ask us any question you wish about stocks, our recommendations, the economy, or the broader market. Ask any question you like, and we'll answer every question we're asked on the chat. Last month, we were online for more than 5 hours answering questions posed by our subscribers. Our next scheduled online chat is coming up in just a few weeks, just enough time for you to read our research and prepare any questions you have. Click the green Subscribe Now button below this video. Sign up for a risk-free trial subscription to Energy and Income Advisor, and we'll rush you all the details of how to log on to an exclusive, subscriber-only online chat. We believe there's no better service on the market today, and all we're asking is that you give us a fair try and see for yourself. If you don't believe it's worth every dime of the subscription price, it's my guarantee that if you cancel in the first 30 days, you'll receive a full refund, no questions asked. And for viewers today, we're offering Energy and Income Advisor at our special introductory price. What have you got to lose? Test our service for 30 days, read our research, and join our monthly web chat. Then decide. If Energy and Income Advisor isn't for you, cancel in the first 30 days, keep your 5 free reports, and I'll refund your full subscription price. No questions asked. Here's to your wealth. To start your risk-free trial, please click the Subscribe Now button below this video and join us today.